Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. I've left highlighted in bright red on my daily chart the neckline of the August to November 2021 complex triple top, and that's currently at 23.90, as it is part of what I suspected last week may be a main new pattern, a large late June to date bump and run reversal top, and we are in the run phase right now. It's not a great example of such a pattern, but it has merit and is pretty far advanced. Not only that, but the hesitation formed late 2 weeks ago between 23 even and 24 even. Well, that does fall in line with the idea for this pattern. So what next? Well, the neckline in bright red has acted as a de facto lower trend line for the bump and run reversal top, and we're into, as I say, the next phase of being below it. The question last week was whether we'd see further declines, and if so, by how far, or if we should see a resurgence back up. I said last week, and I quote, "At the moment, with all the ammunition sitting overhead, from September to date, it still looks like we may have a further attempt lower, down to the combined congestion in the 22.35 zone, and then down to the stratified support starting at 21.48, that stretched down to 19.64, end of quote. So far, we have seen attempts to push lower, but the market is not only being kept up by stratified supports. The first zone is actually between 21.48 down to 20.47. No, not only that, but we have now highlighted on the daily chart and in the frame of the market the April 2020 to date, actually, let's put that, April 2020 to date uptrend, currently at 21.37. This uptrend hasn't got that much pedigree, but it's still there. Not only that, but below the next band of supports between 1964 to 2003, we have the April 2021 to date uptrend, currently at 1953. Meanwhile, topside, beyond bright red neckline, we have a congestion area between 23.90 to 24.08, containing the July 2012 high at 24 even, and the 50% Fibonacci line of the March and the October move at 24.08. Beyond those, we have the 38.2% absolute Fibonacci line at 24.88, and the very slowly rising long moving average, currently at 24.97. Now, going back to the large bump and run reversal top, as I said last week, and I quote, "If we utilize the neckline as the trend line for this pattern, then the theory suggested a move down to a primary target X below in the 21.85 zone, and a secondary harder to reach target X1 down in the 19.35 zone." End of quote. This week, prices dropped down to reach the primary target X at 21.85, though so far they have run into a stone wall with the stratified congestion below, so target X1 remains elusive for the moment. Ice Europe white sugar in London. The break higher over the upper trend line, highlighted in dark blue on my daily chart, currently at 680.70 back in late August, and that's of the late May to late August expanding wedge pattern. Well, that set the stage for the next move higher, though it wasn't an easy delivery. This was a multi-pattern move, as the upper trend line was also the neckline for the late May to late August reverse head and shoulders pattern. The primary target for the expanding wedge pattern in the 769 area was reached, but the secondary harder to reach target up in the 797.30 area was not, and has been retired. At the same time, the primary target for the reverse head and shoulders pattern was reached in the 754.20 area, but here also the secondary harder to reach target up in the 784.90 area was not, and has also been retired. The other notable features were the mid-September to early October dip, forming a reverse head and shoulders bottom, with both targets reached on the top side for that, as well as the formation of an ascending wedge pattern between mid-October to late November. This had been breached on the upside in early November, which will shortly become very important before breaking lower in late November and falling away below the previously mentioned dark blue trend line, and dipping into congestion, starting at the rising long moving average, currently at 692 even, then at 685.90, the March 2012 high at 674.90, the July 2012 high at 663.70, and the 650 to 652.20 congestion zone that contains a 50% Fibonacci line of the January to September 2023 move at 652.20. There is further congestion below at 635.30 and to 638.20, and then stratified supports between 625.30 to 602.70. The recent key feature had been created, or rather, the final part had been created by this move lower. Remember I mentioned the top? The feature is a late August to date double top. Now, the market had previously broken down through the neckline of this double top, and for guidance, I'm using the lesser Fibonacci line at 679 even as a proxy for the neckline. This break lower indicated the following potentials for such a double top pattern: a primary target X down in the 628.30 zone, and a secondary hard to reach target X1 down in the 585.10 zone. Now, despite the whole lot of congestion below, especially in the previously mentioned stratified band between 625.30 to 602.70, the market has managed last week to achieve the primary target below for the double top. That is a target X at 628.30. The secondary target is still alive out there, but we are seeing prices push lower to lows not seen since March this year. Now, I would like to point out one new potential support that has entered the frame, and one that directly affects target X1. And that is the October 2022 to date uptrend, currently at 588 even. It is slicing higher and is now adding its support to the stratified layers. Sugar white premium spread. We're almost at the end of 2023, and this chart continues to be one of the busiest and most colorful of all my charts. Many things are still going on, all at the same time. Okay, so I'd previously spoken some while ago about two big picture items I'd seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, and do not underestimate that one, with prices currently in between the lower time below, currently at 121.5, and the middle time above, currently at 195.75. I've said this so many times before, and I'll keep repeating it here yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. Next, we have an ascending expanding wedge pattern, highlighted in bright red trend lines on my daily chart, and above the current market. This was formed between mid-April to late November last year, that's 2022, and is currently 221.25 to right off the top of my weekly chart. To me, it was and still is not the best looking of such wedge patterns I've seen, but it is also still out there, and it comes with all the possibilities such a pattern invokes. Then there is the most recent activity, and this is where we have seen prices around and on occasion down through all the moving averages, notably the long moving average at 130.75 and the medium moving average currently 140.5. Price has also been pushed down through the two 50% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even, and then moved back up through all of them, and up to the 2013 high at 152.75, before ending up where we are now, sitting on top of the medium moving average, which is currently at 140.5. In the process of doing all this, we also saw the formation of an island gap below, between early September and early November this year. Prices did reach up a few weeks ago, up to the topside target in the 152 even area for this pattern. And that's where the rally halted. I suppose it still all depends once more on what the market does with the overhead 2013 high, 152.75, because beyond that, we have the neckline currently at 159.5, highlighted in pink on my daily chart of the June 2021 to May 2022 reverse head and shoulders bottom, as resistance before we hit the congestion significantly higher at 162.75 to 165.75. And that contains the 2012 high made back in July that year. Now, Many months ago, I drew a bullish shift pitch hook for the August 2021 to February 2023 action. I've once again decided not to highlight it. As with already so many highlighted trend lines here, the action on this pitch hook neither adds nor subtracts from the current picture at this time. The next point I'd like to discuss is once again the previously discussed big picture item. Is to look once more at the whole of the 2022 to date action as a possible huge lopsided diamond top, out of which the prices have emerged during the summer. This is the pattern that's highlighted in green on my daily chart. We initially had a false break higher from this pattern, then recently a false break lower, and so far the market has still not decided as to which way this pattern will drive us. Last time I began to have doubts about this whole idea, and I can see myself retiring this pattern completely unless we see some productive activity in one or other direction, and soon.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.